So you mentioned the low interest rates just before we went to break there, Sam. Let's talk about what that's done to you as an investor. And do you expect the Fed to just keep it down? If not at zero, then just above zero?
It's very hard for me to imagine that the Fed has a choice. Um, at the rate at which we're creating debt, uh, servicing the debt is becoming a bigger and bigger future risk. For many, many years, the average interest rate was 5.6%. Uh, if the government had to pay 5.6% on the debt outstanding today, from a cash flow point of view, we wouldn't have a chance. So I think that the Fed has no choice. Although I would tell you, in my opinion, the overall activity level in the economy is better than people are expecting and people are giving credit to it. Just like this past week, the numbers on manufacturing, showed a significant recovery. I think, generally speaking, business activity is better than you guessed by reading the newspapers.
Well, Sam, as an investor, what do you see in terms of demand for credit? The Fed can lower the cost of credit, not significantly at this point, but is there any real demand? We're not seeing much take-up for their lending programs like Main Street.
Well, I think that, everybody's got, all kinds of a shortage of patience. I promise you that if the Fed had a policy for providing cash flow to closed hotels, there'd be unlimited demand. I think we have a kind of a binary economy at the moment where parts of it, like airlines or tourist or travel, is suffering. Restaurants is suffering very significantly. That the rest of the economy is not suffering.
So are you at a point where you have to offer incentives to people in order to fill up some office space that you own? Or are you negotiating with people? There's a lot of concern about what's going to happen when we get to the end of the year when rates usually reset.
Well, I guess, we are no longer in the office business, thank God. But we are still very much in the residential side. There's no question, particularly in what I would call our two softest markets, New York and San Francisco. Whether it be concessions or lease extensions with other considerations, the net effect of which is that the downside has been a reduction in the net rent generated. The good news in the New York market is that as prices have come down, the number of showings has gone up and the leasing pace and occupancy have increased accordingly. So that's a function of the fact that, demand is forcing a repricing to a certain extent. I think a lot of that repricing and demand change is all very convenient when everybody can work remote. I don't see that occurring for much longer.
Sam, you've mentioned a couple times that you think the economy actually is stronger than you might get from the headlines in the newspaper or, for that matter, on some cable television programs.
Yes.
At the same time, it is hurting some people disproportionately. You mentioned some sectors particularly. Yeah. We've still got 10.5 million people who don't have jobs who did beforehand. What do we need to do to address that issue? And let's be very specific. What about this so-called fiscal stimulus fourth round?
Well, I think that it's quite clear that some additional stimulus would be very helpful, and I would certainly be very supportive of that. At the same time, turning the demand for stimulus into an excuse for just literally solving other, states and cities who have been prolific in terms of the way in which they've spent their capital is very unappetizing. And I think that as long as the results lead to a divided government, I think the restraint will be there. And then I think, helping particularly areas of extreme hurt. I mean, here in the airline business today, you're talking about, 10 or 15 or 20% of the demand that previously existed. In the restaurant business, even when occupancy is banned inside, your chances of breaking even are very little. And if it's limited to 25%, you have a very difficult chance of making it economically viable. So I think that what's needed is a bridge that will get us through the end of COVID, and particularly focused on those arenas that are taking the most amount of pain.
We have just a minute before the break, but let me ask you this. You said that you are concerned about the level of debt out there, but you're also suggesting that we do some more stimulus. How close are we to a tipping point where debt becomes an issue? As long as the Fed keeps rates at zero, can we do whatever we want?
Well, I don't believe we can do whatever we want. I believe the ultimate risk here is the U.S. dollar is the quote reserve currency of the world. And I think that we won't, unfortunately, that won't happen over a very slow, long period of time. It'll happen all of a sudden, when all of a sudden there aren't enough bids for the debt that our country wants to sell. I don't think we're there yet, but I think we're close enough that I'm worried about it.